Did you know that Warren Buffett, one of the richest people on earth, built his fortune without inventing new technology or inheriting vast wealth? That's right. Unlike Elon Musk or Jeff Bezos, Buffett didn't ride the tech boom or inherit billions from family. He started with a modest childhood in Omaha, Nebraska, during the Great Depression, and through patience, discipline, and an unshakable understanding of investment principles, he grew into the Oracle of Omaha. Today, Buffett is reportedly worth over $120 billion, and his story offers lessons in patience, strategy, and understanding value that anyone can apply. Buffett was born in August 1930, just a year after the United States was hit hard by the Great Depression. From an early age, he witnessed how families struggled financially and how money could dictate opportunities. His father, Howard Buffett, was a savvy businessman who, after losing his job at a local bank, used his savings to start a brokerage firm. This not only supported the family, but also introduced young Warren to the world of investing. As a boy, Warren was quiet, observant, and deeply curious about business. He spent countless hours reading books from his father's library, developing an early fascination with investing and financial strategy. By the age of 6, he had already started his first business, selling Coca-Cola door-to-door in his neighborhood. He earned 5 cents per six-pack and quickly expanded to include gum, magazines, and other small items. By 11, Warren used his savings to purchase his first stocks, 3 shares in City Service, an oil and gas company. Though the shares initially fell in value, he held on and eventually sold them for a small profit. This early lesson in patience, market psychology, and value laid the foundation for his investment philosophy. Warren's teenage years only reinforced his entrepreneurial spirit. At 14, he took a job delivering newspapers, earning enough to buy a pinball machine with a friend. They installed it at a local barbershop, eventually acquiring 2 more machines. Profits were split weekly, and when they sold the machines, Warren used the proceeds to buy a 40-acre farm in Nebraska at the age of 15. By high school, he was already developing the skills of a self-made businessman, learning the importance of cash flow, assets, and reinvestment. After high school, Buffett enrolled at the University of Pennsylvania, but later transferred to the University of Nebraska to complete his bachelor's degree in business administration. He applied to Harvard for his master's, but was rejected, a setback that turned out to be a blessing. He enrolled at Columbia Business School, where he met Benjamin Graham, author of the legendary book The Intelligent Investor. Graham taught Buffett the principles of value investing: buy undervalued companies, understand intrinsic value, and avoid speculative behavior. These principles would guide Buffett throughout his career. Upon graduating, Buffett faced a challenge familiar to many young professionals: landing a first job. He was introverted, shy, and nervous about presenting himself to potential employers. To overcome this, he took a public speaking course, a decision he later credited as one of the most valuable investments in himself. Soon after, Graham offered him a position at his investment firm in New York, where Buffett honed his skills in security analysis and learned to evaluate companies based on balance sheets, earnings, and intrinsic value. Although Buffett respected Graham, he eventually diverged philosophically, focusing not just on numbers, but on understanding how companies operated and the quality of management. By 1956, Graham retired, and Buffett returned to Omaha at 25 to start his own partnership, Buffett Associates Limited. Using $105,000 from friends and family, Buffett applied the principles he had learned but took them further. He specialized in cigar butt investing, purchasing companies trading below liquidation value. Like a discarded cigar that still offers a few puffs, these investments provided small, almost risk-free profits that compounded over time. Within 6 years, the partnership grew from $105,000 to $7.2 million, delivering an average annual return of nearly 30%, far outperforming the market. During this period, Buffett faced another challenge: managing rapid growth while still a young man with the appearance of a teenager. Despite skepticism from outsiders, his results spoke for themselves. By 1969, Buffett had built a personal fortune of $25 million, setting the stage for his next major move, transforming Berkshire Hathaway into a holding company capable of generating billions. Berkshire Hathaway was initially a struggling textile company. Buffett acquired shares at around $7.50, expecting to profit from liquidation. But when the final deal undervalued his investment, he bought the entire company. Though the textile industry was declining, Buffett repurposed Berkshire Hathaway as a holding company for future investments. This shift marked a pivotal evolution in his strategy, from buying undervalued companies to investing in great businesses at fair prices. With guidance from Charlie Munger, Buffett began seeking companies with strong economic moats, brands or competitive advantages that protected them from competitors. One iconic example is Coca-Cola. By the 1980s, Coca-Cola had become synonymous with soft drinks globally. Buffett recognized its moat, brand loyalty, global distribution, and a product that was nearly impossible for competitors to replicate. By investing in companies like Coca-Cola, American Express, and the Washington Post, Buffett combined a focus on quality with disciplined valuation. This approach generated extraordinary compounding growth over decades, ultimately contributing to his multi-billion-dollar net worth. Insurance played a crucial role in Buffett's wealth accumulation. Unlike most businesses, insurance companies collect premiums up front, creating large cash reserves known as float. Buffett realized he could invest this float in other businesses, compounding returns significantly. Starting with National Indemnity in 1967 and later acquiring companies like GEICO, Buffett leveraged insurance to fuel growth in his portfolio. This unique strategy allowed him to invest in high-quality businesses using other people's money, a method few investors could replicate effectively. Over the years, Berkshire Hathaway's portfolio expanded to include numerous blue-chip companies. Investments in financial institutions like Bank of America and Goldman Sachs, consumer staples like Coca-Cola, and technology ventures demonstrated Buffett's consistent application of his principles. By the 1990s, Berkshire Hathaway's stock had surged dramatically, and Buffett's personal net worth exceeded $1 billion, cementing his status as one of the wealthiest individuals in history. What sets Buffett apart is not just his wealth, but his disciplined approach to investing. He famously follows the rules: don't lose money and don't forget the first rule. His ability to remain patient, avoid speculation, and focus on long-term value has allowed him to outperform the market consistently. While the average investor reacts to daily news and market fluctuations, Buffett evaluates companies based on fundamentals, cash flow, management quality, and competitive advantage. This mindset, combined with prudent risk management, has created a fortune that continues to grow even in uncertain economic times. Even in 2025, Buffett's influence remains significant. With markets facing rising inflation, potential recessions, and global uncertainty, his principles offer guidance. Contemporary strategies such as investing in real assets, including art, alongside traditional stocks, reflect the ongoing relevance of disciplined, value-based investing. Platforms like Masterworks allow modern investors to diversify similarly to how Buffett utilizes his holdings, highlighting the timeless applicability of his approach. Despite his immense wealth, Buffett remains remarkably frugal. He still drives a modest car, eats simple meals, and prioritizes value over luxury. His lifestyle and philosophy serve as a reminder that long-term success in investing is rooted not in extravagance, but in discipline, patience, and understanding value. Warren Buffett's journey from a shy boy selling Coca-Cola door-to-door to building a multi-billion-dollar empire demonstrates that consistent, disciplined investing can generate extraordinary wealth. His principles, patience, understanding intrinsic value, leveraging opportunities like insurance float, and focusing on companies with durable moats provide a blueprint for investors seeking to navigate complex markets. While few may reach Buffett's level of success, Anyone can apply his methods to make smarter, more informed investment decisions. So, the next time you think about the stock market or consider investing, ask yourself, are you following the rules that Warren Buffett lived by, or are you chasing the next big trend? Share your thoughts in the comments below. We'd love to hear how you approach investing and what lessons from Buffett's life resonate with you.